this afternoon on business valuation uncertainty, risks creating opportunities. We also invite you to attend, if you're interested, a second program this afternoon on the Paycheck Protection Program on the loan forgiveness protocols and procedures related to that from 2:30 to 4 p.m. Presenters for that program will be myself, Don Johnston, a partner in our tax services group, and Mike Weber, senior manager in our tax services group. Note that today's goal for both of these webinars is to present timely information as quickly as we can get it out to you. Because of that, we are not able to provide CLE and CPE credits for today's programs. We are getting qualified to do that, and we've been qualified for both many times. However, the protocols require more time than we were allotted based on developments occurring within these two topics this week. So our goal is to get that as soon as possible. On future invitations to webinars, we will make sure that you are notified if that program does in fact qualify for CLE or CPE credits. Note, to keep things moving along smoothly, everyone on the telephone call, excepting the presenters, are muted. You may send or type questions into the host at your convenience, and we will do our best to address them either in the program or more likely at the end of the program. If your question has a lengthy fact pattern or is specific to your business and not able to be answered quickly, we will probably pass on that program, and you are invited to basically contact any of the presenters today to be able to get that answer, that question answered at your convenience. We also ask you to please keep an eye out following today's sessions for future webinars. We plan to do more of these in the future in light of current circumstances in the country with the health concerns. We also would expect to do some additional ones beyond that once life gets back to normal, or at least as close to normal as we could hope to. So with that, we'll move on to today's program. Today's presenters are going to be principally my partner, Melissa Bizyak, who leads the charge in our Business Valuation Services group, and manager Brad Matthews, who also operates in that group. Both are highly experienced professionals, do a great deal of business valuation work, almost full-time for everybody, excepting special litigation and et cetera, other projects like that. So we have a significant background in these issues. The reason we think it's important to have a webinar today and with this particular topic is that all valuation is time sensitive and date sensitive, and our presenters are going to get into that in great detail as they go through today's program. However, we're in a time like no other time that we've recently known. And so this is an unusual pattern of economic difficulty, and it's basically because this particular turn in the economy is not like mechanical inherent issues that were involved in the 2001 tech bubble pop, nor is it tied into financing issues with loan packages like we saw in 2008, 2009. Those were more fundamental mechanical issues involved in the economy, which affected not only the downturn in the economies in both of those periods, but also the means and the protocols to get out of it and the time frame it took to move from those to growth periods again. This, everyone understands, is basically an episodic event. It's totally tied to the COVID-19. It's hard to imagine now on May 1st that just 2 months ago or 2.5 months ago, the economy was at record levels on many fronts. That's obviously not the case. With this episode, though, even with a protracted time frame for testing and development of ways to battle the COVID-19 virus, it is expected that the event itself is going to be relatively brief. And then the question remains as to what is the potential resolution and how to deal with that resolution and build that into our measures. The problem is, as I mentioned earlier, the valuation date and the concept of valuation is specific to a specific date. So the dates that we're in now, this environment that we're in now, offers an opportunity to look at values depending on where you stand on either side of a transaction or need to basically capitalize on some of the negatives and turn those into positives. And that's going to be basically the emphasis of today's presentation. Without question, there's been an economic contraction in the United States and worldwide. Whether or not that has risen to a full level recession is argumentative and arguable, and certainly commentators are arguing on both sides of that issues. However, keep in mind that historically, again, Federal Reserve is generally in front of these things. That's not the case here. And the reason that's not the case is because most companies at the current time, at this particular date, are not illiquid. They basically are in a posture, a position where they have sufficient funds. It's more of a concern and worry about solvency in the future due to a number of different technical attributes. And again, Melissa and Brad will be spending time today talking about those issues and bringing them to the forefront of your thought processes as well. So you have that issue on the one side, and the economic downturn that results from this episodic event. On the other side, you have an incredibly giving Congress and President in this administration that have basically really created a push to move funds and cash flows into the economy as quickly as possible through these stimulus packages that have been passed over the last 30 to 45 days, including 4 major stimulus packages. So the idea and the hope on the side of Congress then is to put themselves in a posture to hopefully help the economy leapfrog this episodic event. And if we can get back to some level of normalcy with sufficient testing and a viable vaccine, even if it's identified in the next few months and then basically comes to fruition over 18 to 24 months, that still is going to allow us as valuators and you in the audience as users of valuation reports to look at a lower valuation more likely or most likely under current circumstances. So where might that come into play in helping you move forward in your planning and your opportunities for future movement? One is in the state and gift tax matters. And again, we'll be discussing that at length. Litigation matters where there are valuation issues, either through shareholder disputes, minority shareholder buyouts, acquisitions of part of the company from partners, et cetera, and as well as divorce. I mean, unfortunately, divorce is a reality in America. There are property spouses and non-property spouses, and timing is often critical to the planning that goes into those types of transactions as well. So that's another matter to keep in hand and keep in mind as to the effect of this COVID-19 environment and where we're heading as we go out of there. And finally, mergers and acquisitions. Mergers and acquisitions were very active in the last several years and have slowed somewhat in the light of this uncertainty that surrounds the COVID-19 virus and the economic impact and outfall from that, or fallout, I should say. Nevertheless, businesses are going to make acquisitions and they're going to move forward, and there are valuation implications involved in that as well. Keep in mind that all of these things are being monitored and watched very closely by the Grossman, and Ford Business Valuation Services Group. They're monitoring economic developments daily, if not multiple times during a day, to understand where not only the markets are moving, but where the long-term prognosis for the economy is moving, the international economy, and how that affects our clients and our contacts and friends who have clients that are looking for business valuation. So with that brief introduction, I'm going to turn it over to my partner, Melissa, and she's going to take charge from here forward, and we hope you enjoy the presentation.
Thank you, Bob. Good afternoon. This section, I'm going to lay a little bit of groundwork for the remainder of the presentation, tee it up for some of the future aspects of valuation and opportunities and issues that we want to bring to light in the little bit of time we have this afternoon. So with that, just keep in mind, value is always a very perplexing concept, particularly with respect to privately held ownership interests in privately held businesses, those that aren't certainly not traded on a public exchange. Very often, we're called to value companies. Value is front and center issue in strategic decisions, management decisions, and equity owner disputes, litigation, and any type of planting that goes along with that. Also, estate planning, one of the tremendous opportunities that we'll be talking about later this in the presentation. One of the fundamental precepts that we have to keep in mind, though, is value is always forward-looking. It really doesn't matter how the company has performed in the past. We're always looking to the future. The past can be a proxy for the future, certainly, but in terms of value, you only care what the stock is going to do, either in a publicly traded company or a privately held company, once you own it. You want to understand what all of those future benefits are coming back to you in present value terms. All valuations require the use of estimates and judgment. So uncertain times like these will place significant emphasis on those requirements. Additionally, the fundamentals, which we're going to go over this afternoon, the fundamentals of valuation are even more critical than ever as we navigate these uncharted waters of both a national and a global economy. Obviously, the overarching theme of today is going to be the impact of COVID-19. A couple of things I want to keep you in mind and maybe emphasize on what Bob talked about is this crisis was caused by something other than the U.S. economy. We haven't seen something like this in the past. The only thing we can refer to is the Great Recession in 2008. However, there were some key differences between now and then. 2008 was more of a supply side or financially driven type of situation that forced public and private funds to face a liquidity crunch that led to a broader wave of forced selling in the Great Recession. This downturn, however, has been more demand driven, as many industries have been materially and directly impacted by the mandatory and government imposed shelter-in-place orders and a global shutdown to neutralize the spread of COVID-19. So obviously the environment that we're dealing with now is very different. Given the abrupt and social and economic impacts, fear has impacted all industries to a degree. The current, and as of we're speaking today, the current global macroeconomic outlook remains opaque. Some of the things that businesses are going to face due to the closures or the decrease in the demand for their products or services could be supply chain disruptions, labor shortages, certainly revenue declines, potentially increases in bad debt, reduction in cash flow, looking at the failure to meet loan covenants, examining even what loan covenants are for companies that didn't have to worry about that in the past. Impairment of goodwill or other long-lived assets that are held by a company, impairment of inventory. Certainly looking forward, the inability to obtain credit. And lastly, and certainly not least, with respect to certain companies, the inability to continue as a going concern. Today's agenda, what we're going to tackle some high-level issues and concepts to get you thinking along the lines of some of the challenges and opportunities that we will have before us. First, we're going to talk about data valuation considerations. We've been talking about this as a valuation community on a national and global level. We're going to talk about valuation methodologies, also the discounts associated with those methodologies. We're also going to talk about valuation opportunities and issues, and then wrap up with some concluding thoughts. And if we have time, certainly address questions.
All right, so I'm going to talk a little bit about the data valuation. Data valuation being the effective date of the analysis in any valuation. So the data valuation is a critical element in any valuation project because value is a point-in-time measurement. So value will change over time, and that data valuation is going to dictate what the valuator must consider. So again, the whole point of valuation, the underlying theory, is that we are quantifying that hypothetical sales price between a hypothetical buyer, hypothetical seller. So what the data valuation will drive is, what is that buyer, what is that seller, what are they actually have access to as of that specific date. So the common term that you hear whenever you're discussing data valuation is, what is known or knowable as of that date. Now, when we talk about subsequent events to that data valuation, in reality, a valuation project, usually a evaluator is going to be engaged post what the effective date is going to be, maybe shortly after, maybe a few months after, and then it obviously takes a couple weeks for the valuation analysis to be performed. For that reason, the report, the final valuation report, could be in excess of a month after the effective date of the analysis. So there are these events that will occur subsequent to that effective date that could have an impact on the date of value, or impact on the value of the business. Unfortunately, fortunately or unfortunately, I guess I should say, is that those subsequent events will not be considered in the actual analysis, the valuation analysis for that company as of that date. So right now in our hopper, we have a number of valuations that we're working on that are 12/31/2019 valuations, or even shortly thereafter. Now, as we'll see when I start laying out the timeline, the impact, the true impact on the economy of COVID-19 was not known or knowable as of 12/31/2019. For that reason, we can't consider any of that information whenever we're looking at that business as of 12/31/2019. Those events will be disclosed, especially ones as significant as COVID-19. Those events will be disclosed in the report, but they will not be included in the valuation analysis or valuation opinion. So the impact of COVID-19 on valuations goes back to that idea of, when was COVID-19 known or knowable, and what is the data valuation, and how do those two mesh up with one another? I'm thinking about valuation, oftentimes we think about the public markets as being the valuation of publicly traded companies that is constantly changing. So if we go back to our intro to finance classes, the efficient market hypothesis is basically a theory that says the reason that those trading prices change constantly is because those investors are fully knowledgeable and are incorporating all the available information as of any specific date into the pricing of those shares of stock. That's what's going to drive the increases and decreases. So we can use those as kind of indicators whenever we're looking at privately held businesses that obviously aren't trading on a day-by-day basis. So what we saw through the beginning of 2020, the capital markets experienced a rapid decline since late February. The S&P 500 fell almost 20% in the first 3 months of the year. Russell 2000 fell 30% in the first 3 months of the year. So here we have kind of an illustrative look at what that looks like. So this information we pulled as of the end of March, so for the first 3 months of the year. So kind of think of this illustration in thirds, the left third, the center third, and the right third. So the leftmost third is the month of January. We didn't really see much change, if any, in the public markets, the pricing of publicly traded companies. That middle third, we did see a little bit more change, and actually through the first half of February, we saw increases in both the S&P 500 and the Russell 2000. And it wasn't until that last week of February where we saw that decrease in the value of those stocks. And then obviously the rightmost third, extreme volatility in March, really dropping off through the first half of March with a little bit of bottoming out in the second half of March. So what can we derive from these stock markets? Really, it's going to be a signal to us as evaluators as to when information was considered by investors. So while the value of private company is unlikely to change at the same percentage as the public exchanges, it does give us as the evaluator an idea as to when an investor would include additional risk in their analysis. And Melissa, if you go back real quick to that slide again, I looked at it as of today. So through April, we actually saw the S&P 500 went from, at the end of March there, it was at about a negative 20% decline from the beginning of the year. That has increased through the month of April. Now it's at a negative 10% decline year to date. The Russell 2000 is around a negative 20% decline. So we saw increases in both of those indexes through April, and the real bottoming out was, in that mid to late March timeframe. So we extracted a timeline of events just for perspective in terms of information that was coming out during the pandemic, and to kind of frame that in what we saw in the public markets. So in the month of January, we saw on the 21st, the first confirmed case in Washington state. And at the end of the month is when the World Health Organization declared a global emergency and the United States began to restrict travel from China. Now remember, we didn't see much change in that January time frame to pricing in the public market. So what we can glean from that is investors really didn't consider these specific pieces that risky whenever they were trading publicly traded stocks. It wasn't until late February when President Trump asked Congress for that $1.25 billion in response to COVID-19, and on that same day, the CDC reported the first case of the transmission to a patient that did not have any travel history outside of the area. That February 23rd day is right when we really began to see volatility in the market. By the end of February, we had the first reported death in the United States. Now, interestingly enough, on the news, I think in this most recent week, although at the end of February is when it was believed that it was the first coronavirus-related death, we later came to find out that there were 2 deaths prior to that, sometime in mid-February. So again, although that information is out as we sit here today, on February 29th, or I guess February 28th, it was not assumed that there had been any coronavirus-related deaths. So this timing is very important. In March, President Trump blocked visitors from Europe in mid-March and then declared a national emergency on the 13th. Now, this is when we really began to see the severe reaction in the public markets. Near the end of the month, New York City was declared the epicenter. President Trump signed the stimulus bill on the 27th, a $2.2 trillion economic rescue package. And by the end of March, 80% of Americans were under lockdown, with 35 states having stay-at-home orders. Now remember, when we are looking at that chart, that late March timeframe is really when we saw the bottoming out. So when we see an increase late March and an increase during the month of April, really what we can suspect is investors are now taking into consideration that new information that has become available. So this timeline will continue to evolve, but markets have increased in April. And generally what we're seeing is reaction to news about potential vaccines or potential treatments, as well as, at this point, states beginning to ease some of those restrictions, both on businesses and on individuals in terms of employees and being able to go back to work. So all of that information has been incorporated into the public markets as a signal, as a little bit less risk in this publicly traded stocks. So as we kind of summarize the data valuation, the data valuation is critical. It's a fundamental element in any valuation, but even more, it's going to be critical for all valuations post that February 2020 timeframe. It's definitely a conversation that we're having with all of our clients that we're going through right now, and we'll be, going through coming up here, is what impact can be considered in the analysis. Remember, a evaluator can't consider anything that has happened subsequent to the data valuation, whether it be positive or negative. If you think valuing a business at the beginning of March, when we really saw a lot of volatility, you can't take into consideration the fact that in April we saw more of a rebound. So it's only what we can consider as of that day. And what does this mean for future projects or even current projects that have data valuation in this COVID-19 pandemic timeframe? Really, all of the engagements that we're going to look at are likely to require some type of financial forecast put together by management. Now, we completely understand and respect the difficulty in forecasting financials on a regular basis. I think it's probably the biggest pushback that we get from management whenever we're going through evaluation is the difficulty it is in being able to forecast 3, 4, 5 years out, just because there are so many unknowns. Well, that's obviously even more the case in the times that we live in today, because every day it seems like we get a new outlook as to what's going to happen with the economy and with privately held businesses going forward. So although it is difficult to put these forecasts together, and extremely difficult now, you need to understand that it's unlikely that businesses are going to look the same in 2020 or even 2021 that they did in 2019. So for that reason, we're going to need some type of forecast. We all can hope that the economy and business returns to a place that we saw in 2019, 2018, but until we get to that point, we need to understand the financial impact on these businesses, at least for that short-term time frame. And for that reason, we're going to have to try and put something together, at least in the short term. Now, keep in mind, one of the things that we always say to clients is, although forecasting is difficult, the onus is on management just to make sure that they're putting forth a good faith effort in the preparation of those financial forecasts, considering what is known or knowable as of that date. So it's even more pertinent in these times that management is not going to be attacked because actual results will end up being different than forecasted results, because it's just that much more difficult for us to be able to put those numbers down, that pen to paper.
I guess, Brad, thank you. I guess from the audience perspective, the question is, does this change the value of your clients' companies, or does it change the way that we would do the valuation? And I think the answer to that is probably yes to both. You know, as Brad said, we're going to have to make a determination when we're doing valuations that are near this period or future, basically trying to determine if the effect on those future projections are going to be episodic and short-term, or if they're going to have a longer, more significant bearing on the value conclusion. And that's a big deal in conjunction with the work that we do here in the valuation arena, because again, we're going to be looking not only at the company's performance on a historical basis, but you're going to have to evaluate in doing the projections that Brad's talking about, looking at your vendors and suppliers and your customers, and making sure that you can get that money back. It's going to be talked about a great deal more, but just have a sense that it probably has some effect, perhaps not as pronounced as the market information that we've shown you generally, because we all know that the market moves fairly emotionally, and we're hoping that those emotional movements in the S&P and so forth aren't carried forward into most small privately held companies.
With that, we're gonna shift gears and talk about valuation approaches and methodologies from a high level. We're going to thread through each of the three broad approaches the impact that we perceive of COVID-19. Starting with the cost approach, really the cost approach is based on a principle of substitution, meaning that a prudent buyer will not pay more for a property or an asset than the cost of acquiring a substitute property or asset for equivalent utility. So determining the value of an asset or an business under the cost asset approach is predicated upon a fair market value assessment of each asset and each liability on a company's balance sheet. Typically, this approach is not very useful for operating companies that would have significant unrecorded liabilities. Because if you think about it, on your balance sheet, you're not, under generally accepted accounting principles, you're not going to record the value of your customers, the value of your technology, your assembled workforce, and even just general goodwill. That's not going to be recorded on the balance sheet. So often, when we're preparing valuations for operating companies, we're typically not using the cost asset approach, because if you think about it, it's really a backstop for investor loss. If you get to a situation where a company is better off dead than alive, you're going to then assess the value of your assets, hopefully on an orderly liquidation process, and then satisfy liabilities, leaving over the remainder for the equity shareholders. The typical place where we use the cost asset approach is going to be for holding companies, companies where the value is placed in their underlying assets, namely real estate holding companies. That's the typical business that comes to mind. But now, in this current environment, we may need to consider the cost asset approach in situations where the income approach values are significantly depressed. We want to take a look to see, do we have an instance where the company is better off, dead than alive? The other side of this, asset holding company values will likely decline after COVID-19, and we're talking about underlying assets held in marketable securities, public market securities, are likely depressed. Real estate entities based on changes in occupancy rates, and these rates could continue, these depressed rates could continue in the foreseeable future. However, when I talk about opportunities towards the end of the program today, I will speak to what can be done for holding companies such as this in an estate planning arena while values are depressed.
So I'll talk a little bit about the market approach. When we think about the market approach, we're talking about this concept of substitution. So usually when you think of a market approach, the easiest thing to relate it to is a house appraisal. A house in my neighborhood sold very similar to mine. I can basically understand what the value of my house is based on what that house sold for. I can apply the same in a business valuation standpoint. So really it comes down to this concept of comparability in terms of finding companies that we believe are comparable to the company that we're analyzing, whether that be a company that is traded on the public exchange or a company that was just acquired in a recent transaction. In the market approach, we're going to derive the trading multiples from those companies, either from the exchange or from the reported information on a closed transaction. We're going to take that trading multiple and apply it to our subject company. So the basic equation that we're looking at is the equity value is going to be that multiple that we've derived either from the public exchange or from the transaction. We're going to apply that same multiple, whether it be price to EBITDA, price to income, price to revenue, to our subject company's EBITDA or income or revenue. And then to get to the equity value, we're going to subtract the debt from the overall enterprise value. So this approach incorporates actual investor expectations. So again, what we're trying to do is quantify a hypothetical sales price for our subject company. What better way to do that than to take actual either sales price or trading prices of similar companies and apply that to arrive at an indication of value. So this approach is easy to understand from a high level, which is why there are many courts and other arenas that favor this. There are two methods, and we're going to talk about both of them. The guideline publicly traded company method is the method from which we're going to be looking at multiples derived from those publicly traded companies. So oftentimes you'll be looking at price to earnings ratios are a commonly reported metric whenever we're talking about public companies. But we also have the ability to go in and quantify what is the gross enterprise value as a function of EBITDA or earnings or revenue. So we're going to take that multiple of the public market and apply it to our subject company. So public markets do incorporate those risk return considerations in pricing stocks. So when Melissa talks about the income approach, we talk about needing to derive what an investor's perceived risk would be of the subject company. On the market approach, that is all built into those multiples already, whether it be somebody that actually purchased a business or investors trading on the public exchange. So the indicated value that comes out of the guideline public company method is consistent with that actual investor outlook. We're taking actual transactions and applying them to our specific company. Now, care has to be taken in this environment when we rely on multiples of the public company method, because they will not be relevant if we believe that a public company would expect to react more or less favorably to a pandemic. So when we think about it, most public companies, even today, still have access to capital that we are probably not going to see from a privately held business. They also likely have risk mitigation strategies that even though their value may go down, we are not going to be able to see those same risk mitigation efforts in a smaller privately held business. So for that reason, those multiples may not be relevant during this time. However, if we are able to determine that the multiples are relevant and that there's sufficient comparability with these public companies, those multiples need to be applied very cautiously. You know, Melissa emphasized that value is always forward-looking. So if we're looking at multiples to a trailing 12 months earnings figure, that multiple may not be relevant today because our earnings next year may be completely different than our earnings from the last 12 months. So due care needs to be used whenever looking at this method. Now switching over to the guideline completed transaction method. In this method, value indicators come from completed transactions of primarily privately held businesses. It's either a private transaction or it's the delisting of a public company, that company being purchased by a privately held business. So there are numerous databases that capture these privately held transactions, unlike the guideline publicly traded company method where there's a significant amount of reporting, the financial reporting to the SEC and otherwise. In the guideline transaction method, we can only capture and use this data if it has been reported to these databases. So frequently an issue exists in making sure that we have sufficient financial information on these transactions to be able to rely on it and use it in the valuation. If a transaction happens, if I see a restaurant across the street change hands, if the financial terms of that deal are never disclosed, then I won't be able to use that in my valuation analysis. So for that reason, this method is usually used as a confirming method, if at all. Now, the issue that we always have with the guideline transaction method is timing. So unlike the publicly traded companies which constantly reprice the shares of stock, this transaction is only going to occur at a specific time. So whenever we have that transaction, we need to take into consideration everything that's happening in the economy, in the business, and otherwise as of that specific time frame. So previously, we were having issues using this method whenever we had data valuation that was after the enactment of the Tax Cuts and Jobs Act. So if you think about we're looking at a company post-TCJA, and we have multiples that happen from transactions occurring before the enactment of the Tax Act, that happened in a completely different tax regime. Similarly, we're going to have the same type of issue with this COVID-19 pandemic. You know, if we have a data valuation that's in the middle of the year this year, in the middle of this pandemic, it's going to be hard for us to look at multiples from 5 years ago and say that those are applicable to our company as of this date. Now, looking forward, the same could be said when we eventually do return to a more normal state of the economy. Say 3 years down the line, everything is opened back up again, it's more business as usual. If we're looking at transactions that may have occurred during the pandemic, it's going to be hard for us to place any reliance on that because it's a completely different economic atmosphere that transaction happened in. So to kind of summarize the market approach, the benefit of the market approach is really the fact that it relies on estimating the hypothetical sales price using actual third-party data. The issues that we're going to have with it are primarily around timing. So for the guideline publicly traded method, it's with so much volatility in those publicly traded stock prices, is that really provide an accurate indication of value for our subject company? With the guideline completed transaction method, are we finding multiples that are in an economic and financial enough time frame, close enough time frame, to consider them applicable. On top of that, making sure that we have a sufficient amount of quality data and making sure that we're truly able to get our arms around that financial data.
I would say that, post TCJA, we were having significant difficulty in applying the market approach in any method thereunder to develop a primary indication of value. Most oftentimes we would attempt to use that as a secondary or confirming method. I think in current times, with the amount of adjustments that would need to be made to both the multiple itself as well as the underlying company metric, you'll probably see a situation where we will consider the market approach. However, it won't be relied upon for an indication of value. I think that in any setting where you have someone else taking a look at the report, IRS, DOL, anytime you're making significant subjective adjustments, we're going to run into some issues trying to defend that value. So I think just to put a bow on the market approach, which Brad described in a very efficient and great manner, we're probably not going to use that going forward until we have some more stability, both in the company metric as well as the guideline company metric that we're applying it to. Switching gears to the income approach. Income approach is the method that we are using as the primary method for giving our opinion of value to most privately held businesses that we're valuing. The income approach is the simplest way to determine future economic benefit streams, as well as to assess the associated risk with those economic benefit streams. And most oftentimes, that economic benefit stream that we're trying to isolate is the expected future cash flow that's being derived or being generated from the business. And going back to the cost asset approach, and the reason why we're typically not using a cost asset or balance sheet approach in valuing a operating business is because that cash flow that the business is generating at the end of the year or throughout the year is a return on two things. It's a return on all of the fixed or hard assets that are recorded on the balance sheet, and it's also a return on all of those intangible assets, those things that aren't recorded on the balance sheet. So one of the difficulties that we are going to have to walk through here is looking at those future cash flows and trying to assess what that return is, both on the tangible as well as the intangible assets. The income approach is based on the economic principle of anticipation, that future-looking concept. As we said, value is always forward-looking. I also noted, laying the background for the presentation, that past performance of a company or even an asset owned by a company has little or no relevance, especially now. The primary drivers of calculating value under the income approach, pretty simplistic. It's a formula containing both a numerator and a denominator. The numerator is going to reflect a future expected economic benefit stream, typically cash flow. We might be looking at net earnings, but whatever that future expected economic benefit stream is, that's going to comprise the numerator of an income approach calculation. The denominator is going to be that risk that's associated with realizing any and all of those future benefits. Two primary methodologies that we employ under an income approach going to be a discounted future economic benefit method, typically looking at cash flow. We typically call that a DCF methodology, wherein we're looking at a series of calculations over a discrete period, as well as a terminal value, considering the business as a going concern and has value going out into the terminal year, into the terminal period. The second methodology is the capitalized future economic benefit method. And that is where we employ a single calculation with growth that is assumed to be constant, where we have growth that's assumed to be linear. In a DCF method, the reason why we're using discrete period forecasts is that we have non-linear growth. Very important, as Brad and Bob have both discussed, at the current dates of valuation, we might see growth that is very or lack thereof, that's going to be non-linear. Both methods, though, are based on predictive inputs. We have many clients that speak to us that may not be able to put together a set of forecasts and think that we can derive a value from historical performance. Understand that we can only use historical performance if it's a proxy for the future. So we're faced with a situation now where if we have an issue in developing forecasts of the future, we might be looking at history, but history will have to be adjusted and probably adjusted significantly. In discussing that numerator, that future cash flow, future income of the business, some of the things that we have been talking about here is that certainly future revenue and expenses will likely experience fluctuations from historical results. We understand that development of forecasts will require substantial judgment that's going to be based on all facts and information at the time of the valuation. Again, that keys off of the date of valuation, what was known or knowable at that date. Understanding that at the current time, things are evolving pretty rapidly. So it might be extremely difficult to determine when recovery would happen if you have a date of valuation, potentially March or April of this year. Increased emphasis will be placed on management prepared forecasts if we're using a discounted cash flow model. We may have situations where management as a tool might be looking at probability analysis, looking at different scenarios. Situations like that may help management and help the evaluator to come up with the most likely set of forecasts going forward. The key consideration will be assessing the impact of the pandemic on both near-term and long-term prospective information. Near-term, certainly over the discrete period of any forecasts that are developed, and then long-term will be considered in growth rate assumptions that the valuation team will be using to develop that terminal value representative of the value of the company beyond the discrete period of the forecast. Some of the things that we think that should be considered in the development of the numerator of the income approach formula would be the following. Needs to be considered how will products and services be delivered during periods of disruption, or will they be delivered at all? What is the length of the disruption, and how long will it take for the company to recover? Certainly, at this time, those two items are very uncertain in looking at a date of valuation currently. Are any customers in distress or out of business? If you have a business that has customer concentration and potentially one of your major customers have gone out of business or is going out of business, that will have a material impact on your company. Have your suppliers been disrupted, and for how long? How will working capital requirements and cash management be impacted? I would assume that management policies in closely held businesses for working capital and cash management will be much more conservative than they have been in the past. Is the company maintaining compliance with debt covenants? Very important. We will see a lot of companies now looking to their credit facilities, potentially line of credits, to see if they have any headroom to sustain them through some of these difficult times. Will capital expenditures, capital investment need to be deferred into the future in order to conserve cash? Also, we will be looking at, has the company received assistance as the result of the Economic Injury Disaster Loan Program or the Paycheck Protection Program? This is very important as these things might be modeled into a discounted cash flow model. Also, adjustments will need to be made in light of taking advantage of certain of these stimulus packages. Also, we will be very concerned with what was the company's debt situation prior to the pandemic. Obviously, if the company was more leveraged prior to COVID-19, we might see some more dire circumstances.
Miss, the comment you make is interesting with respect to probability analysis, and that's important in valuation, of course, equally important, basically encompassing the same approach, in stress testing your projections for your company coming out of this pandemic economic situation. And so ultimately, having an opportunity to look at the projections that you're putting together, assigning probabilities as Melissa has indicated, or stress testing each of those elements that she's addressed very, very ardently in her presentation. Those are things that you need to be thinking about as a business owner or a business manager in moving your company forward, even if this is not the exact or appropriate time that you might acquire business valuation. Looking at that type of probability analysis is huge in moving forward.
So as you can see, tremendous difficulty and challenge in deriving the numerator of the income approach formula. Switching gears and looking at the denominator, which is going to be that risk rate or discount rate, as we call it. The selection of a discount rate is really to align the relative risk associated with an investment in the subject entity compared to an alternative investment option and their associated rates of return. So basically, what we are charged with is developing a risk rate or a discount rate that is specific to the company at hand. And beyond the discussion for today, there are commonly accepted methodologies that valuators use to estimate or develop that discount rate. Most of the inputs will be determined or used from empirical data. However, there are some subjective adjustments that are specifically based on the risk associated with the subject company achieving those future cash flows. So obviously, the discount rate will consider those factors that management has included in their forecast, and basically testing those factors to determine whether there is additional risk beyond what has been reflected in the assumptions that are used in the underlying forecast. Times of crisis, obviously with extraordinary market volatility, requires valuators to view the inputs in the development of the risk rate through very different lens. Just to give you an example, similarly in 2008, our 20-year Treasury yield fell in a flight to quality. Currently, that rate in the Treasury yield is slightly over 1%. Just to give you some perspective, at valuation dates as of 12/31/2019, that rate was about 2.25. So this decrease is actually directionally opposite of the increased risk inherent in making an investment in a closely held business. So when I say that valuators need to look at or view this discount rate or risk rate through a different lens, it's because certain of the inputs that we derive from empirical data are going to show a lower return, thus actually indicating an increase in value when we know that during this time, the actual product of applying that discount rate should be a higher rate, resulting in a lower value. Understand that there's an inverse relationship between the risk rate and value. So the higher the risk rate, the lower the value. So just wrapping up the income approach, obviously application of this approach for dates of valuation post-COVID-19 will be challenging indeed. We understand that changes are occurring globally and are material and certainly fluid. We do feel that adjustments will need to be made to both the numerator, the cash flow of the business, the future expected cash flow of the business, as well as the denominator, that risk rate that's associated with the expected cash flow of the business. While either of these inputs may change in a direction that by themselves pushes down value, for some small, closely held businesses, both inputs, when assessed as of the current date, may push downward pressure on valuations. So what we're saying is, typically, we can see a depression potentially in the numerator in the cash flow, but we may not see a reduction in risk. We feel that we're in a time now where we're going to see a reduction in both numerator and denominator, which will ultimately depress values even further. That was just to give you a high-level discussion on all three of the valuation approaches that we use, issues that we're perceiving, certainly unfolding. Any type of valuations that are being prepared at the current time are probably going to see the most uncertainty, the most risk associated with future cash flow.
All right, so we're going to talk a little bit about valuation discounts now. So after a gross value of the business is calculated through either the income approach or the market approach or the cost asset approach, valuation discounts are then applied to that value to get to the pro rata value of that subject interest. So the valuation discounts are trying to capture additional decreases in value based on the specific bundle of rights associated with whatever ownership interest that we are analyzing specifically. So when we think about discounts, the two most common discounts that we see are discount for lack of control and discount for lack of marketability. Those discounts, again, relate specifically to the attributes of that ownership interest under consideration. So there are numerous internal and external factors that affect the size of the discount, but there are no prescribed ranges for those discounts. It, again, is really dependent on the bundle of rights associated with that ownership interest, as well as what is the indicated value coming out of those approaches that we've considered. We need to go from the gross value of the enterprise, 100% of the company, and then say we only own a pro rata share. The ownership interest that we're looking at owns a fraction of that. What additional negative impacts to the gross value need to be considered to make sure that we're valuing the fair market value of that specific ownership interest? So when we look at the two discounts, the discount for lack of control and the discount for lack of marketability, it's the discount for lack of marketability that is going to be most impacted by COVID-19. So what the discount for lack of marketability is it's that negative impact to value based on the inability to convert the ownership interest in the business into cash. So when we think about holding a share of Apple, we can very quickly turn that into cash in a number of days. We can liquidate that investment. When we look at privately held businesses, we are not going to be able to have that same amount of liquidity, especially if we're looking at some fractional interest of a privately held business. So what the DLOM aims to capture is what is that negative impact to value because we don't have that liquidity associated with owning this business. So it's defined as the amount deducted from the value of an ownership interest to reflect that relative absence of marketability. So what are things that can impact the discount for lack of marketability in general? An uncertain time horizon to complete a sale. Well, think about COVID-19. A number of transactions right now that might have been going on or in process are going to be on hold, whether that be buyer or seller specific issues related to what has happened to the operations or the financials of the business, or whether it just be restrictions that we're currently living under, an inability to be able to do the proper due diligence because of the restrictions that have been placed on businesses in different states. And also, what is the risk to the eventual sales price? What is the inability to hypothecate the sale or borrow against the estimated value of the stock? All of these things can serve to increase that discount for lack of marketability, meaning that negative impact on the value of the specific ownership interest. So think about the chart that we looked at earlier, the stock market in the first quarter. We've seen a dramatic increase in the price volatility. And along with that, we have much more uncertainty surrounding the sustainability of business operations. That's even more magnified when you think about your privately held businesses. Think about all the local businesses that are not operating right now. So these factors that could impact the discount for lack of marketability are likely going to have an overall increase on discount. So the risk associated with the ability to turn that investment into cash recognizes that time and effort that it takes to do so. So as that risk increases, so will the discount for lack of marketability. Now, Melissa will talk a little bit about estate planning here in a short period, but this increase in the discounts coupled with the decrease in the expected cash flows and the increased risk just have an overall negative effect on the value of a fractional ownership interest in a privately held business. Now, what that can do is it can create opportunities in many instances to move value in a cost-efficient way.
We're going to talk a little bit about valuation opportunities and issues associated with certain types of valuations or valuations in different settings. There are a few arenas where we're going to see tremendous opportunities, and then there are other areas of valuation that we will see some challenges, albeit due to uncertain times. One of the areas where we think we're going to see a lot of opportunities is in the area of estate and gift planning valuations. Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." The current global pandemic and political climate, we think, combine to create a significant estate planning opportunity or opportunities. If you think about it, we're in a perfect storm for thoughtful estate planning. As a result of the Tax Cuts and Jobs Act of 2017, the exemption amount for estates and gifts was almost 11.6 million in 2020, 23 million for a couple. That exemption returns to approximately 6 million in 2026, provided that we don't have a change in political parties. However, in current time, if Mr. Biden is able to win the presidential election, he has released a 10-step plan for increasing tax revenue. It doesn't currently address the TCJA exemptions. However, it does plan to seek to eliminate a step up in basis on decedents' transfers of appreciated assets, which could be very important. One thing commentators are speaking about is that if we do have a change in a political party and also the Democrats win control of the Senate flips, we will likely see a significant decrease in that exemption amount. So we think that there's definitely tremendous opportunities in estate and gift tax valuations. Now, gifting strategies are typically chosen and directed by legal counsel, and we participate on those teams, specifically as it speaks to data valuation, giving our opinions as to what we see as the best or best as we see data valuation for making a meaningful gift. Some of the impacting factors for data selection, data valuation selection is currently we're seeing asset values are likely decreased, whether it be in a closely held operating business, a holding company with assets that are in real estate or in marketable securities. Those values have likely decreased. As Brad had said, valuation discounts, and specifically the discount for lack of marketability, has likely increased. We also have a current tax environment and proposed changes to the estate and gift tax laws that would prompt us to think strategically now about helping our clients in a gifting strategy. So we feel that in a situation where you have depressed values for the foreseeable future, along with a political climate that may potentially force clients to speed up some estate planning, we're going to see a situation where we have tremendous opportunities to transfer some wealth at depressed values. In a litigation setting, we're called to do valuations for a number of things. Shareholder buyouts, and sometimes those buyouts turn to a contentious situation. Nonetheless, some of the challenges that we can see here is, if we have a situation where a buyout was imminent, or if you're thinking about being bought out of the company now, you need to be thinking about what does that value look like to me. Certainly, to a company buying back your shares, this might be a good time to look at something or entertain something like that due to depressed values. On the other side, the shareholders might not be in a position to take that depressed value. Certainly would need to be looked at. Divorce, as Bob had said, is certainly a situation that's not going anywhere. We have asset spouses that see this as a very good time to take advantage of depressed values. Certainly, you have non-asset spouses on the other side that might sit back and look and wonder if this is truly an equitable situation in terms of divorce proceedings. So understand that there will be opportunities to asset spouses for valuing some of their assets, including closely held businesses, at more of a depressed value during these uncertain times. Another area would be damages calculations, lost profits, things like that. I participated on a webinar yesterday by an insurance professional that spoke to a lot of her clients want to look into business disruption. Is that a claim that's able to be made under COVID-19? And what most insurance companies are saying is, well, submit the claim and we will decide afterwards. I can tell you that the answer yesterday was most oftentimes it's going to be no. However, there will be some damages calculations with respect to certain business interruptions that might be submitted to insurance companies. The only thing I would say is potentially a viable claim would be a loss of inventory during times like this, but certainly not business disruptions, since everyone is going to be subject to that. And I'm sure that there's language in the insurance policies to prevent policyholders from recovering damages because of the stay-in-place orders by the government. Nonetheless, in litigation valuation, the data valuation in these matters are going to be very impactful. Most oftentimes, though, this date is going to be determined by court, legal statute, a date of a court filing. So, we're kind of in a situation here where you can't be very strategic about that particular data valuation where it's mandated by a party outside of the business and the business's advisors. The other comment I would make that would be interesting at this time is, in a shareholder buyout situation, whether it's contentious or not, refer to the governing documents, and those documents would either be a shareholder or a buy-sell agreement that sets forth a date of valuation. It should be clearly stated in there. However, I would be looking for languages that consider material changes in the operations and financial activities of the business between the date of valuation that's mandated and then the closing date. I would check to see if there's specific language contained in those agreements that would speak to material changes, because potentially there could be an adjustment to that buyout price. Just some things I think to be mindful of in a litigation situation. However, most oftentimes we are working under mandates of the court. Most of the engagements that we had in litigation proceedings, since most courts were put on hold, those assignments for us are kind of remaining stagnant as well. So we're looking to get back to certain of those matters and determining how, if at all, we can consider any impact of COVID-19 on those valuations.
Yeah, the current circumstances are such, and Melissa and I have talked about this several times, that perhaps this is a reasonable time for mediation if you've had protracted litigation and you can't get over the valuation dispute. Just because the unknowns are so significant that the selling parties or the parties receiving proceeds in the settlement, they may have to wait 24, 36 months further to get to an answer. And on the other side, the payor and the defendant side of the matter, the reality is, he or she may not be able to get a better deal than you can come up with now. Not necessarily that you can really depress preliminary offers, but that you may not have to go as high as you might have otherwise had to go in a more normal economic environment.
And just to quickly give you some of my thoughts on business merger and acquisition activity. Really, COVID-19's financial and operational impacts on businesses affect many aspects of deals, from deal strategy and targeting to integration and value creation, which will be very important. We're quickly transitioning from a long-running seller's market to one that's favoring buyers, and most likely buyers with strong capital positions. But make no mistake, we feel that buyers will be likely becoming more assertive in agreements and negotiation. And when I speak to agreements and negotiation, looking for clawbacks to compensate for overpaying. We may see some contingent consideration, earnouts. Typically we've seen them build into more risky transactions, say for development companies. We might be seeing that more to become accustomed in just a normal M&A transaction. Value creation in deals, deal making is now more critical than ever. There's going to be a focus on the approach to forecasting. Forecasting is going to have to be much more disciplined. And as Bob and I talked about, assessing different probabilities, assessing which would be the most likely situation. We're likely to see an increase in sellers willing to offer financing to bridge capital needs that may not be currently available from third parties. I think in any case, buyers are going to rethink the cost of financing and consider alternatives in the light of the current situation.
Yeah, we did have a question on that that came through from a member of the audience with respect to whether or not PE funds are going to be out there looking for transactions. I don't know, depending on the length of time that this economic diminishment or difficulty lasts, whether they will turn away from making acquisitions. But I still think acquirers with liquidity, as Melissa mentioned earlier, are out there looking for targets. The issue, in my mind, would be finding willing sellers who are willing to concede, the value differential in the current economic environment. If you're a seller who's 74 years old, you may have a circumstance that dictates you're going to have to go with the lower values. On the other hand, if you have a strong operational company and you're just in this temporary blip, if you will, our thinking is that, those transactions won't happen because owners will hold hold their ownership for a certain amount of time to see if it comes back up.
So I'll talk a little bit about ESOP. So an employee stock ownership plan, or ESOP, for those who don't know what it is, it's a qualified retirement plan. It serves to invest primarily in the sponsor company's stock. So the ESOP actually goes and purchases the shares of stock from the owner or ownership group, puts them in a trust, and holds it on for the benefit of the participants being the employees of that company. So the nice part about these type of plans is that the employees share in the benefit of increased value of that sponsor company. So it aligns many goals. There's also a lot of positive tax implications associated with ESOP companies. We have a specialty in valuing ESOPs. We have a number of ESOPs in our portfolio, and it's work that we get to do on an annual basis. The DOL requires that the valuation of ESOPs happen at least annually. So unlike your 401k that invests in publicly traded companies, you can, for your 401k, you can at any point in time go and look at what is the value right now. For an ESOP, being a qualified retirement plan, you still need to understand the value of the owner, or the value of the company, the sponsor company, because the participants need to understand the value in their retirement plan. There's also a put option associated with these shares. So what that is the participants have the ability upon certain triggering events to require that that sponsor company purchase their shares back from them. So usually what we think of as triggering events, so an employee retires, they have the ability to liquidate that investment. If they are able to vest and elect diversification, so they want to take the value that they have invested in their employer and exchange it for investments in other types of publicly traded stock, they have the ability to diversify. So whenever they trigger this put option, the company, it requires the company to buy those shares back from that employee. So this does a number of things. This creates an unrecorded repurchase obligation on the book that doesn't actually hit the books of the sponsor company. That obligation is really the present value of all of those put options for all of the plan participants. So what is the present value of all the money that the company will need to spend to be able to satisfy those put obligations? So for that reason, it requires a regular update of the share price of that company's stock. So when we think about dates of valuation for ESOP companies, two buckets that we think about. It's either the date of a transaction, so at some point the ESOP will actually engage in a transaction with the owner or the ownership group to buy the shares of stock from the company and then hold it within the trust. At any one of those transactions, whether it be buying it 100% or buying those shares in stages, it requires a valuation of the company. Also, as I mentioned, the ESOP needs to be valued at least annually, according to the DOL. Now, the reason that it needs to be valued annually is that the ESOP has to pay what is labeled by the DOL as adequate consideration. Really means the ESOP has to pay a fair price for those shares of stock, because on either side of that transaction, they don't want to harm either a participant or the plan. So if an ESOP overpays for the shares of stock whenever an employee elects to diversify, then the ESOP has actually harmed the current plan participants because it spent more money than it had to. On the flip side, if an ESOP underpays for the shares of stock whenever an employee retires or elects diversification, then that participant, that exiting participant, has been harmed by not receiving a fair value for their shares of stock. So when those transactions need to happen is going to be dictated either by the trustee or the ESOP plan documents. So we have many ESOPs that we're looking at right now that are wondering, what do we need to do with all of this COVID-19 information in terms of potentially updating our valuation or getting an entirely different valuation? And so it provides the opportunity to do a few things. The first is making sure that trustees, that management groups within these companies take a look at those ESOP plan documents, because if the document does not speak to requiring another valuation in times like this, or if they believe the value of the business dropped a certain amount, then they're doing harm to the current participants of the plan. So it's something that we are advising all of our ESOP clients, take a look at those documents because they're the drivers. But also what it allows them to do is, if they do indeed elect to proceed with another valuation, then they will have an updated share price to make sure that those transactions, those put transactions, are fair to both the buyer and the seller, the buyer being the company, the seller being the participant in the plan. So it may require, this COVID-19 may require interim valuations for many ESOP companies. What's really going to determine that is, again, the documents, the source documents, the ESOP plan documents, as well as the real expectation as to how this will impact that specific company. If it's a company that has been shut down during the pandemic, then it's expected there's a significant decrease in value. That might warrant a new valuation. If it's a company that has actually done well, say manufacturing of PPE, then maybe they're actually doing much better, and it's fair to the participants to increase that share price through a new valuation. So provide the opportunity to update that value and take a look at those plan documents. Now, in terms of the application of discounts to an ESOP plan, primarily, again, what we're going to be looking at is, what is that discount for lack of marketability, and has that discount for lack of marketability changed? In an ESOP in general, compared to an exactly equivalent non-ESOP company, the DLOM is much smaller than you would expect because there is a market for the shares of the stock. There's a pseudo market in that put option. However, the discount will always aim to capture those specific bundle of rights associated with the ESOP shares. So the DOL has put DLOM's discounts for lack of marketability in an extreme focus and making sure that that's fair to the participant. Discounts during this time period need to make sure that they capture all of the risks associated with that ownership interest. Primarily, what we expect is those discounts may increase due to the inability of the sponsor company to satisfy those repurchase obligations in the event that they aren't able to make those payments. So shifting gears over to goodwill impairment. So goodwill impairment for financial reporting. Goodwill, as we know, is an intangible asset recorded on the company's balance sheet. And the asset itself, goodwill sitting in other assets on the balance sheet, it's supported when the fair value of the company exceeds its carrying value. So basically, in layman's terms, when the company has intangible value, we know that it's worth more than just the assets that sit on the balance sheet at any given time. If the fair value decreases, then that goodwill can become impaired. So if the fair value of the company decreases and becomes less than the carrying value, then that will impair that intangible value in the form of goodwill. You no longer have that value that's supported because that value of the business has decreased. So that recognition of the impairment is going to result in a charge against the reported earnings, as well as a write-down of the asset value on the balance sheet. So what we can expect in this pandemic timeframe is that there's likely going to be an increase in at least impairment testing, if not an increase in the recognition of the impairment, as we see the decrease in the business values that we've talked about in the various methodologies. So it's measured as of that financial reporting date. So if a company believes that as of that date that the fair value is decreased enough to warrant an impairment test, then it looks like that's going to be an additional step that needs to be taken. And then to kind of wrap it up with exit planning in general, exit planning, as we know, is likely going to be delayed. You know, the transactions, we've seen a number of transactions put on hold or forced to be put on hold because of the restrictions that were placed under. Again, the inability to do the proper due diligence, the issues that companies are facing both financially and operationally. There may need to be additional runway for those planning purposes, and primarily, business owners may need to explore other type of options. You can think about maybe finding a different type of buyer. If those synergistic buyers are unwilling to proceed with the transaction because they've had operational issues, if maybe we don't have PE firms coming in because they're afraid of the risk associated with the investment, you might need to look for other types of buyers, maybe a sale to employees or a sale to the ESOP. But exit planning in general is definitely going to change, as we know. We just need to understand how long that process may take and what are the options available to that business owner.
Yeah, and I think one of the orderly options in terms of exits being, gifting shares to junior generation remaining on, senior generation remaining on in the business. As we said, that's one of the biggest opportunities that we're going to see during this time. So those certainly, those exit plans certainly won't be delayed. Certainly ongoing. Potentially people that were not thinking of an exit may be on their radar screen now, and as Brad said, giving them a little bit more runway. But to wrap this up, and I think we have a couple more questions before we let you go, just some thoughts. We do think that the value of many privately held businesses will be negatively impacted by the COVID-19 crisis. I think we're going to see this almost as a value continuum. At one end of the spectrum will be companies experiencing a minor or temporary decline in value. As Bob had said, for some companies, this might be a blip on their radar screen. But at the other end, the decline in value could be significant and potentially permanent. As I noted before, we may have some small businesses that won't survive this crisis. At the end of the day, any opinion of value that we'll be giving will include an assessment of a host of factors, many factors and circumstances that exist at the date of valuation. So all of the things that we are considering, the industry, the financial performance of the company, the economy, will be based on what is known or knowable at that specific date. Understand for planning purposes that value can change over time. And we think that during this time, now more than ever, we can see dramatic changes in value over time, depending on the assessment of those inputs and those factors that are specific to a date of valuation. The only other thing we would say is that consideration should be given to a lot of the opportunities that are occurring at this time, namely in the estate and gift tax arena. Buyers that have the capital and capability to acquire companies that may be in distress. These are prime opportunities. Divorce situations where you have an asset spouse that is looking to depress certain values of their assets, can take advantage of opportunities that are presenting themselves at this time.
Yeah, and with that, let us wrap up with a couple of questions while we have a few minutes left. We had one question from an attendee in the audience. Do we see DLOMs increasing? And I think Brad said yes. And then the question follow-up from the attendee was, how high do we see that, or how much of an increase do we see in DLOMs? That's a difficult question to answer because every determination of a discount, whether it's for marketability or control, is predicated on facts and circumstances associated with the particular equity interest. I would suggest, however, though broadly, you wouldn't see really substantial increases in the discount for lack of marketability, only because, again, right now, most prognosticators are looking at more of a short-term effect of this particular economic influence, this COVID-19. So, those discounts may prove to grow more than I'm expecting at the current time. We won't know that till we get out a little bit further and see how this comes back. The other side of that is again, the probability assessment, the stress testing that Melissa was talking about. If you're looking at your company and you have a few problems, a few stresses on your potential bounce back, perhaps you have a vendor that's in big trouble. I mean, that's going to prove to be a shorter term impact on your projections going forward if you can find a replacement, within a few months. So those are the kind of things that go into impacting the DLOM as well. We also had a question on the effect of the PPP loan forgiveness on the value of the companies that we're looking at. That's a great question, and we've been talking about that in our valuation services group, and we've been trying to deal with that on our broader plane. Depending on the date of valuation, there's a number of issues that are involved in that kind of a determination. The first being how much of the loan will be forgiven, and if those provisions were in place before the law. Again, the date of valuation, as Brad and Melissa have so aptly described. But if you find that the loan forgiveness is going to come through, then we're going to have to assess, if it's not occurred yet, if you're still in your 8-week covered period, our team is going to have to assess whether or not you're likely to meet the qualifications for loan forgiveness, whether or not the loan forgiveness percentage will be the maximum loan that you borrowed or some portion of that loan, and then ultimately, with recent developments in the optics in the marketplace with respect to big companies borrowing loans, a question of whether or not you're going to have to give that money back or not. I guess my thought would be, and I'd ask Melissa and Brad for comments, that my thought would be that if you have a loan that is forgiven at some point, that the valuation will be done without consideration of that loan forgiveness, and whatever the value detriment is, we would probably end up adding back that particular influx of cash as a non-operating cash item of some type to bring value back up to help offset some of the value detriment. But to be honest with you, the people in the audience, the verdict is still out on exactly how these loans are going to be contemplated. And Melissa and I both, assume that it's going to be a case-by-case assessment.
Yeah, no, Bob, I would agree with you. The treatment would probably be a non-operating asset in the form of excess cash or working capital being added back. Do we have any more questions? Yeah,
the only other question that we had was someone asked if we're aware of the status of the banks. Are they still open to refinancing? Are they still open to looking at lending and supporting clients? And I can't answer that. We're not really in the banking industry specifically, but I would tell people on the call today that I have personally numerous clients that are working with their banks right now on refis, and it doesn't seem like the COVID-19 is slowing down that activity at the current time. Perhaps it's not as profitable with the interest rates where they are as where they might be in the long term, but at least right now I do know and am aware of several banks working with our clients who are trying to obtain financing to help them get through this particular issue.
I think many clients are looking for that headroom in their lines of credit to sustain operations a little bit longer. With all that, we would like to thank you for your time and your participation. Please visit our website. We have it was the other slide. Yeah. We have a COVID-19 section and a resource center if you'd like to have additional information. Also, the slides for today will be uploaded to our website. Please, if you can, join Bob's conversation at 2:30 this afternoon on the PPP. Thank you and have a great day.
Thank you all.
Thank you, everybody.